let's break down the annual revenues and annual cash, and to get to the net annual cash inflows. This is given information also. The new machine, the annual revenues would be greater than the old machine because the old machine is running inefficiently. So the new machine would be the increased annual revenues to 1.15 million. The old machine is 950,000. Annual cash operating costs of the new machine would be 425,000, and the old machine would be 550,000. So the net annual cash inflows of the new machine would be 725,000, and the old machine would be 400,000. So although we get increased net cash inflows on an annual basis for the new machine, we need to determine whether the costs associated with acquiring the new equipment outweigh that. All right, so and the way we do that is by looking at the present value of the future cash flows. All right, let's look at the discounted cash flows for the new machine. Initial investment happens today, so the present value factor of 1. That's 4 million out. It's a negative. It's cash outflow. Required maintenance in year 5, another cash flow out. We need a present value factor of $1 5 years from now at 9%. That's 0.650. Multiply the 150 times the present value factor. We get 97,485. Net annual cash inflows. So this is an annuity factor, right? Because we're going to get this amount of cash per year for the next 12 years. We are given it above. The net annual cash inflows are 725,000. Multiply that by the annuity factor of $1 at 9% for 12 years. That's 7.161. That gets us net present value cash inflows of $5,191,725. Salvage value of old equipment. If we are to select the alternative of the new machine, then we would have this salvage value of the old equipment because we'd get rid of it. So if we kept the new old equipment, we wouldn't get that cash. If we got the new equipment, we would get a cash. So it is it's information that it differs between the two alternatives, right? So it's relevant, so we need to include it here. So that 50,000 is a cash inflow now because we'd get rid of the old equipment now. So that's a factor of 1. 50,000 is positive. And then the salvage value of the old equipment is from 12 years from now, it's $110,000 at a present value factor of 9%. 10 years from now, that's 0.356. Total cash inflows, total cash outflows. We get the net present value of all cash flows to be $1,183,345. Now let's take the discounted cash flows of the old machine. The initial investment or to refurbish the equipment is $475,000 at a present value factor of 1 because it happens right now, negative cash flow. The required maintenance per year, and we have to do this every year because it's an old machine, so there's a lot more upkeep associated with it. So per year we'd have to pay $65,000. So it would be an annuity factor of 1 for 12 years at 9%. But this is negative because it's cash out, it's not cash in. And then we got the net annual cash inflows of $400,000, which was given above, at the same annuity factor. That's $2,864,400. Add the cash inflows, cash outflows, we get to $1,923,935. Let's compare the two. Refurbishing the old equipment actually yields a greater net present value than the old machine. So, and actually in this instance, it makes more sense to keep the old machine and refurbish it. Let's look at the incremental cost approach. Remember the incremental cost approach, we went through the concepts and definitions. The incremental cost approach only weighs the relevant cost, similar to what we did in Lesson 10 where we're only looking at relevant cost. This is what that does, but it takes the relevant cost and the present value sum. So, round belly management analyzes, so the information from 3 in the brown boxes above we're going to take, but we're only going to compare the incremental cost, the different costs in this example. Round belly management also analyzes the two alternatives using the incremental cost approach. In this approach, management only looks at those costs that differ between the two alternatives. No, we arrive at the same answer that investing in the new equipment yields less discounted cash flows. So the incremental investment now is the difference between the 4 million and the 475,000, which is the 3,525,000, right? Because we're looking at the difference. What's the cash? What is the difference? When cash flows differ between alternatives, that's what's relevant. So we're only looking at the difference. So the difference between cash flows now for the new machine and the old machine is 3,525,000. Present value factor of 1 because that's cash out today. Required maintenance in year 5 of the new machine we wouldn't have to incur if we stay with the old machine, so we present value that. required maintenance per year for 12 years of the old machine. Remember, if we went with the new machine, we wouldn't have to do the required maintenance on the old machine, so that's a relevant cost, present value of that. Increased cash, the difference between the cash inflows of the new machine and the old machine is $325,000. Remember, we're only looking at incremental, the difference between the two. Salvage value of the old equipment, now it's a relevant cost, because if we stay with the old equipment we wouldn't have the salvage value, so it's a relevant cost. And then the salvage value of the new equipment, which was 12 years from now, that's a relevant cost, so we present value that. We sum the net cash inflows and outflows, and we'll come up with a net disadvantage that going with the new machine is $740,590 disadvantage, and that's the same amount we came up doing number 3. But that was through the incremental, just looking at the differing costs. Now let's go to 5. Assume management have to decide between investing in the contract that we talked about in 1, which was supplying mast mounting parts, and we'll refer to that as Project A, or supplying the Newport Sailing Club, which we went through in 2, and we'll call that Project B. So they have to decide between A or B. Round belly management note that it is difficult to differentiate, or difficult to decide between two projects that have different initial investments and net cash flows. Therefore, they have calculated the profitability index of each project in the table below. The higher the profitability index, the more profitable the project. Which project should round belly management choose? Well, if you look, the profitability index equation is present value of cash flows over investment required. So for Project A, the present value of cash flows, present value of cash inflows for Project A is the annual net cash inflows of $1,658,563 over our required investment, which is the $1,436,500. That's the information from the present value table, the light blue up here, from 1. And that gets us a profitability index of 1.15. The profitability index of Project B, which is the sailing club boats, that we take the present value of cash inflows, which annual net cash inflows were $399,525, over the initial required investment of $375,000, we get a profitability index of 1.07. So Project A has a higher profitability index, so we should go with Project A. Simple rate of return. Assume management at Round Belly have selected to go with Project A, the mast mounting parts. Management has calculated the simple rate of return below. Simple rate of return equals annual incremental net operating income over initial investment. Simple rate of return equals $437,500, which is our remember, it's not the present value, it's actually the accounting income, which is our incremental annual net cash inflows of $437,500 over our initial investment of $1,436,500, gets us a 30% rate of return on this project. And then we'll calculate the payback period. Assume Round Belly management have selected to go with Project A, the mast mounting parts. Management has calculated the payback period below. So payback period equals investment required over net annual cash inflows, net annual cash flow. And remember, this is accounting cash flow, not present value cash flow. We get the initial investment of $1,436,500 over the net annual cash flow of $437,500 to get to 3.2 years as our payback period. All right, let's go to 6. Least cost decision. HMS Round Belly Inc. HMS Round Belly Inc.'s management is currently reviewing the productivity of certain assets. It has noted that certain piers used to dock boats while undergoing quality control inspections are in need of serious repairs. Round Belly management notes that it can not directly attribute cash flows from the piers. All right, when you cannot directly attribute cash flows to certain projects, you have to go with the least cost decision, right? So that's what we're going to do here. It is considering the two alternatives: refurbish the old piers or purchase new piers. For this type of project, management requires a 9% rate of return. Management has gathered the information below, which alternative should Round Belly select. Refurbish old pier. Overhaul costs now, right? We'd have to spend that cash now is $375,000. Annual maintenance cost to upkeep the piers would be $100,000. Salvage value in 10 years would be $25,000, and the salvage value now is $15,000. purchase new pier. The purchase price is $900,000. Annual maintenance cost would be $12,000, and salvage value in 10 years would be $75,000. Okay, discounted cash flows purchasing the new pier. The purchase price now is $900,000. We pay that a factor of 1 because we're paying it right now, so that's $900,000 cash out. Annual operating costs. So we need an annuity factor because these are going to be annual cash flows. The annuity factor of at 9% of for 10 years is 6.418. It's the same as above. Wait, sorry. Oh no, we're still at the purchase of new pier. My bad. Annual operating costs. So that's a new annuity factor 6.418. That's $77,016. Salvage value of old pier, we'd get that cash now. Remember, if we get rid of the old pier, we can salvage it and get money. That's a decision that differs between alternatives. That's a cost that differs between alternatives, so it's relevant. So we're going to look at that. Salvage value of old pier now is $15,000, and it's the present value of 1 because it's now. And then the salvage value of the new pier, which is 10 years from now, it's going to be $75,000. So we need a present value factor of $1 at 9%. 10 years from now, that's 0.422. Do the math, add it all up, we get to the net present value of cash flows to be negative 9. Cash outflows of $930,336. Now let's do the discounted cash flows of refurbishing the old pier. Overhaul cost right now is $375,000 at a present value factor of 1 because it's right now. It's $375,000 cash out. Annual operating costs are $100,000. It's going to cost more to maintain this old pier, so it's $100,000 per year versus the $12,000 for the new pier. At a present value factor, well, since it's annual cash flow, we need to do the annuity. The annuity of $1 for 10 years at 9% is 6.418, which was the same as above, but now it's $100,000. So we get a cash outflow of $641,800, and then the salvage value of the old pier 10 years from now we determined was $25,000. So we take the present value of $1 10 years from now at 9% is same as above, 0.422, and that yields $10,560. Add up all those cash flows, and we get $1,006,240. We compare the alternatives. We say the net present value of acquiring a new pier is $930,336. Net present value of keeping the old pier is $1,006,240. It costs less to buy the new pier. Go with the new pier. That's how management uses net present value to assess decisions, through the incremental cost approach, total cost approach, least cost approach, and that's how they calculate payback period and the simple rate of return. That's lesson 11.